So a bomb just dropped on one of India's fastest growing private banks, IDFC First. A massive fraud has come to light, and now investors are stuck at a crossroads. Is this a fatal flaw, a sign of a much deeper crisis, or is this a golden opportunity to buy into a good bank after a major market overreaction?
And boy, did the market react. The moment the news broke, the stock took an absolute nosedive, a 20% plunge in a single day. When you see a fifth of a company's value get wiped out just like that, you know investors are spooked. It absolutely demands a closer look. And that really is the core question on everyone's mind, isn't it? In this explainer, we're going to tear this whole situation apart. We'll look at what happened, what the real damage is, both financially and to its reputation, and how the bank is handling the fallout. The goal here is to figure out if this is a symptom of a rotten core or just a very, very expensive mistake. Okay, let's dive right into the heart of the matter. We're talking about a 590 crore rupee shock to the system, an amount that's going to leave a very visible mark on the bank's next earnings report. So here's the rundown of what we know so far. The bank uncovered a fraud worth 590 crores, and this wasn't spread out. It was concentrated in one single branch in Chandigarh. The accounts that got hit belonged to various departments of the Haryana state government. And the whole thing blew up when these government departments went to move their money, only to find the accounts were not what they should have been. Right away, the suspicion fell on a few employees working at that specific branch. Understanding how they pulled this off is absolutely key, because it tells us exactly where the internal controls failed. So let's deconstruct the mechanics of this heist. You know, the bank's own CEO, V. Vaidyanathan, was incredibly blunt about it. He came right out and said this wasn't some high-tech cyber heist. In his own words, this was the oldest kind of fraud probably known to banking. That tells you a lot. This was about people and paper, not a failure of their core digital systems. So how did this actually go down? Well, it started with large fixed deposits from the Haryana government. Then, a few employees at the branch allegedly teamed up with people on the outside. They used old-school methods, forged physical checks, to move the money out. The funds were then scattered across multiple accounts in different banks to cover their tracks. The whole house of cards came tumbling down when several departments, by pure chance, tried to withdraw their money all at once. Suddenly, the empty accounts were exposed. This points to a total breakdown of the most basic security protocol in banking, the maker-checker system. All right, 590 crores. It sounds like a massive number, and it is. But for a bank the size of IDFC First, what does that number actually mean? Let's put it into context. This chart really puts things into perspective. That 590 crore hit is actually bigger than the bank's entire net profit from the last quarter. So yeah, depending on how they account for it, this one event could essentially wipe out a whole quarter's worth of earnings. That hurts. But then you look at the bank's total net worth, over 46,000 crores. The fraud amount is just a tiny sliver of that, about 1.3%. So while it's a huge blow to their profitability in the short term, it's not an existential threat to the bank's survival. But you know, the financial hit is one thing. The ripple effects, that's a whole other story. The Haryana government has already pulled its business, which is a big reputational blow. The bank is going to have to shell out for a top-tier forensic audit with KPMG, and there's no guarantee they'll get all that money back. But honestly, the biggest risk, the one you can't put on a balance sheet, is the loss of trust. That's the currency that really matters in banking. In a crisis like this, what you do in the first 48 hours is absolutely critical. It can make or break you. So let's see how the bank and the regulators stepped up to control the damage. Okay, you have to give them credit for one thing. They moved fast. They didn't try to hide it. They immediately disclosed the issue to everyone, regulators, the public, you name it. 4 officials were suspended right away. They filed a police complaint to get a criminal investigation going. They brought in the big guns, KPMG, for an independent audit. And crucially, they started trying to claw the money back by asking other banks to freeze those suspicious accounts. Textbook crisis management, really. But perhaps the most important response came from the top dog itself, the Reserve Bank of India. The RBI stepped in to calm the markets, basically saying this looks like a one-off problem and not, in their words, a systemic kind of issue. Now, for investors, that's a huge signal. It means the central bank doesn't think this is a disease that's going to spread across the entire banking sector. So all of this, it brings us right back to that central dilemma for any investor looking at this stock. Was this just a blip, a really bad day at the office for one branch? Or does it point to something rotten deep inside the bank's culture and control systems? All right, let's break down the two sides of this debate. The case for this being just an isolated blip is pretty compelling. The CEO is hammering the point that it was one branch out of more than 1,000. The RBI has backed them up, saying it's not a systemic risk, and the fraud itself was low tech. But the arguments on the other side are just as serious. This was a complete failure of the most basic banking control system. That doesn't happen without multiple employees colluding. And the reputational damage is real. They've already lost a major government client.
Now, to really get a handle on this, it helps to compare it to other big banking scandals we've seen in India. Remember the PNB scam? That was a massive tech failure. The Yes Bank crisis? That was a total breakdown in governance and risk-taking right from the top. The IDFC First case, at least as it looks right now, is different. It's being framed as a classic operational failure, a breach of physical processes and employee integrity at the ground level. The nature of the failure is an important distinction. Okay, so we've dissected the what, the how, and the why. Now for the most important part. What do you, as an investor, do with all this information? Let's build a playbook for making a smart decision. Let's lay out the bull case versus the bear case. If you're an optimist, the bull case is this. Management is handling it transparently, the financial damage is survivable, and that 20% stock drop is a classic market overreaction. This could be a great buying opportunity. But if you're a pessimist, the bear case is that this reveals a shocking failure of governments, we still don't know the full financial damage, and the loss of trust could haunt the bank for years, slowing its growth. So, moving forward, what should you be keeping a close eye on? Here are the 4 key things to watch. First, the final report from that KPMG audit. That will be the definitive story. Second, the recovery numbers. Every crore they get back is a win. Third, watch the bank's next quarterly results to see how much money they set aside to cover this loss. And finally, and most importantly, what specific changes does management make to make sure this can never, ever happen again? And so we end right where we began. What would a smart investor do now? Well, it really comes down to your own philosophy. If you're a value investor, you're asking if that 20% price drop is enough to compensate you for the new risk. If you're a growth investor, you're worried this whole mess will slow the bank down. A smart investor will weigh all this evidence, keep a close eye on those key triggers we just talked about, and decide if management's next moves are strong enough to rebuild the most valuable asset in banking: trust.